Imagine a financial institution where you're not just, a customer, but actually a member. And its main goal isn't profit, but serving you and the community. That really is the heart of what a credit union is all about. Today, we're taking a deep dive into the legal framework, the bedrock, that governs these pretty unique financial entities. Our mission is to kind of distill these often complex legal documents for you. We want to give you the essential nuggets, the key facts, maybe even some surprising ones, so you can quickly get up to speed on how credit unions work and, importantly, how they're changing. We'll first navigate the details of a significant recent proposal, the Credit Union Board Modernization Act. Then we'll pull back the curtain on the foundation itself, the Federal Credit Union Act, which is really the original blueprint for the whole system. We're drawing our insights directly from these two key pieces of legislation. H.R.975, that's the Credit Union Board Modernization Act, which just passed the House, and the really comprehensive Federal Credit Union Act, the one that shaped these institutions for decades. And you might actually be surprised by the level of detail in the rules. They cover everything from how often credit union boards have to meet, to the kinds of loans they can offer, even how your money is insured. These details, they directly impact your financial experience and, well, the stability of the entire credit union system. So, okay, let's unpack this. What exactly is being changed right now, and why does it matter for, credit unions and their members?
That's a really crucial starting point, because this proposed Credit Union Board Modernization Act, H.R.975, it represents a pretty significant step in how credit unions are governed. Now, this bill might seem like it's focused on maybe a dry topic board meeting frequency, but its implications are actually much broader. They touch on the efficiency and oversight of credit unions all across the country. It recently moved through the legislative process. It passed the House of Representatives back in February 2025.
Okay.
And since then, it's been received by the Senate, where it's now under review by the Committee on Banking, Housing, and Urban Affairs. As the name suggests, its primary purpose is pretty clear: to amend the Federal Credit Union Act to modify the frequency of board of directors meetings and, for other related purposes.
So this bill, if it becomes law, is really all about updating how often these credit union boards need to get together.
Yeah.
But it's not just a simple tweak, is it? It sounds like it introduces a much more, nuanced approach.
You've absolutely hit the key point there. The fundamental shift H.R.975 is proposing is a move away from a rigid kind of one-size-fits-all rule towards something more tailored, a risk-based system. The original rule, you find it in Section 113 of the longstanding Federal Credit Union Act. It just mandated that the board of directors shall meet at least once a month.
Simple enough.
Very simple.
Wow.
And it applied universally. Every single federal credit union, didn't matter its size, its financial health, or how long it had been around. H.R. 975 targets that specific clause directly. It proposes to remove that blanket monthly requirement and introduce this new tiered system. What's really fascinating here is how this mirrors a broader trend we're seeing in financial regulation. It acknowledges that, different credit unions face different oversight needs. A healthy, well-managed institution might not need the same constant, granular oversight as one that's just starting out or maybe experiencing some difficulties. It's really about optimizing the regulatory burden while keeping things safe and sound for members.
That tiered system does sound like a common sense evolution, doesn't it? Really tailoring the oversight to the specific situation. Can you walk us through the specific categories this bill introduces and explain their new meeting frequencies? Because that seems like where the real impact is.
Absolutely. The bill lays out 3 distinct tiers for board meeting frequencies. Each one is carefully designed to line up with the credit union's unique circumstances, its age, its financial health, things like that. So first we have what are called de novo federal credit unions. These are the newly established ones.
Startups, basically.
Exactly, the startups. For these, the requirement stays pretty strict. Their boards must meet not less frequently than monthly during each of the first 5 years of their existence.
So monthly for the first 5 years.
That's right. It keeps that strict monthly requirement for the brand new credit unions, and, for good reason. New institutions just inherently carry higher risk. They're in their formative years, right? They're setting up procedures, building their member base, navigating those initial financial hurdles. So more frequent oversight is crucial during this critical period. It ensures close monitoring as they establish sound practices, bid stability, and that ultimately protects both their new members and the wider financial system by, catching potential issues early on.
Okay, so the new ones get the same strict scrutiny as before.
Yeah.
That makes sense. But what about the established ones? The successful credit unions, that's where you mentioned the regulatory relief comes in.
Precisely. For well-performing federal credit unions, the reduction in how often they have to meet is quite significant.
Okay.
Now, to qualify for this reduced requirement, a credit union has to meet specific criteria. It's about their financial health and their management. They need a composite rating of either 1 or 2 under the Uniform Financial Institutions rating system that's often called UFIRS.
UFIs, right, like a report card.
Exactly like a report card for financial institutions. 1 is the best, 5 is the worst. So they need a 1 or 2 composite rating, and D, they also need a capability of management rating of either 1 or 2.
So top marks all around.
Pretty much. A rating of 1 or 2 generally signals a strong, healthy institution. Sound management, minimal supervisory concern. These are the credit unions operating efficiently, managing risks well, maintaining robust financial health. For these top-performing institutions, the proposed requirement is to meet not less than 6 times annually, with at least 1 meeting held during each fiscal quarter.
6 times a year, minimum, down from 12.
Right, a significant reduction. It means they only have to meet 6 times a year, minimum. And there's flexibility as long as they meet at least once every 3 months, once per quarter. They can distribute those 6 meetings however works best for them throughout the year.
That sounds much more efficient.
The rationale is exactly that. Reduce unnecessary administrative burden. Allow these efficient, well-managed credit unions more operational flexibility. It's about trusting stable institutions to manage their own schedules more autonomously, while still making sure there are regular quarterly check-ins for strategic oversight. Think about it. It frees up the board members' time. Many of them are volunteers, remember.
Right, that's a key point about credit unions.
It lets them focus more on strategic initiatives rather than just, the routine compliance of monthly meetings.
That truly makes perfect sense. You don't want to bog down institutions that are clearly doing well with unnecessary paperwork or meetings. But then, what about the flip side? Credit unions that might be struggling. How does this tiered system handle them?
That brings us neatly to the third tier, troubled federal credit unions. For these, the rules actually tighten up considerably. Often it means reinstating or just maintaining that monthly meeting requirement. A credit union falls into this category if it has a composite UFIRS rating of 3, 4, or 5, or if its capability of management rating is 3, 4, or 5.
So, the lower end of that report card.
Exactly. As we said, UFIRS ratings of 3, 4, or 5 indicate a credit union with moderate to severe deficiencies, either financially or managerially. They require increased supervisory attention. This could stem from issues with asset quality, earnings, liquidity, overall management, a range of things. For these credit unions, the requirement is clear. The board of directors must meet not less frequently than once a month.
Back to monthly then.
Back to monthly. This ensures monthly meetings or even mandates them where they might have been relaxed for the well-performing ones. These more frequent meetings are absolutely critical for several reasons. They enable prompt discussion and resolution of emerging issues. They facilitate developing and implementing corrective action plans. And ultimately, they help protect both member interests and the National Credit Union Share Insurance Fund from potential losses. It's about ensuring that when a credit union is facing challenges, its leadership is actively engaged, meeting frequently to steer it back towards health.
That's a really smart system. It adapts the level of oversight based on the actual health and stage of the institution. So, summing up this proposed Credit Union Board Modernization Act, it creates a dynamic meeting schedule. It adapts to the life stage, the financial health of the credit union, rather than sticking to that rigid universal mandate.
That's the core idea.
For healthy credit unions, it promises less administrative burden, more flexibility. For struggling ones, it means enhanced oversight, quicker intervention, faster resolution of issues. This could genuinely lead to more efficient operations across the whole industry. And here's where it gets really compelling, I think. Because this isn't just about ticking boxes on a calendar, right? It's about making governance truly effective.
Absolutely.
But how does this proposed change fit into the bigger picture, the whole landscape of credit union regulation? To really understand that, we need to go back to the beginning, back to the foundational law that actually established these unique financial institutions in the first place.
Indeed. To fully appreciate the significance of something like H.R.975, we really have to delve into its origins. We need to look at the foundational legislation it amends, the Federal Credit Union Act. And this act, it isn't just some dry legal document. It's really rooted in a fundamental idea, cooperative finance for everyday people.
Right.
This comprehensive law, it was first enacted way back in 1934. Think about that during the Great Depression.
Wow, maybe.
And it's been updated periodically since then, most recently in late 2022, to adapt to the changing financial world. It's formally known simply as the Federal Credit Union Act. The congressional intent behind it, stated right in the preamble, was quite profound. It was to make more available to people of small means credit for provident purposes through a national system of cooperative credit.
People of small means. So specific.
Very specific, thereby helping to stabilize the credit structure of the United States. Think about that purpose. It wasn't just about setting up financial entities, it was about promoting thrift, encouraging saving, and providing access to affordable credit, especially for those who might have been underserved by traditional banks, particularly during that tough economic time. It's truly a mission-driven piece of legislation, which raises an important question. How does that original mission actually show up in the specific rules and regulations, the ones that govern how credit unions operate day to day, how they interact with their members, and with the wider financial system?
That's a crucial point. Understanding the why behind the what, the philosophy driving the rules. So let's start with the basics, the building blocks. The Act defines a lot of key terms, and understanding them is almost like getting a map of the credit union world. It quickly clarifies the key players, their roles, helps you see the underlying structure. What are some of those really foundational definitions?
Absolutely. The Act begins by providing essentially a glossary. These terms are vital for navigating its provisions. So the term Federal Credit Union itself, it's defined as a cooperative association organized for the purpose of promoting thrift among its members and creating a source of credit for provident or productive purposes.
Cooperative association .thrift .credit. That sums it up.
It really does. It highlights their member-owned, nonprofit nature and that core mission, helping people save and get credit for beneficial things. When you see terms like chairman, administration, or board, these refer specifically to the chairman of the National Credit Union Administration, the NCUA itself, and the National Credit Union Administration Board. The primary regulators, exactly, the governing body for federal credit unions. The terms member account and account are defined pretty broadly. They include shares, share certificates, share draft accounts, basically different ways members hold money savings, CDs, checking. It also covers accounts for low-income members or certain government units, reflecting that community focus. A state credit union is simply one organized under state laws, but generally following similar cooperative principles. Then there's the crucial distinction between an insured credit union and a non-insured credit union. This links directly to the NCUSF, the insurance fund we'll definitely talk more about later. That's what protects your money.
Okay, insured versus non-insured.
Got it. The fund is specifically shorthand for that National Credit Union Share Insurance Fund. Very important concept. And finally, the term branch gets a broad definition. It covers various types of offices where accounts are open or money is lent. Interestingly, this even includes offices on American military bases overseas, showing the system's reach.
Understanding these terms truly is like getting that map. It clarifies the players, the roles, helps you see the structure of these cooperative institutions and how they're regulated. So with those terms in mind, let's talk about the main watchdog, the National Credit Union Administration, the NCUA. What's its structure like? What are its core responsibilities?
Right. The National Credit Union Administration, NCUA, as established in the Act, it's designed as an independent agency within the executive branch. Its structure is quite deliberate, aiming for robust and impartial oversight. The board itself, it has 3 members, broadly representing the public interest. They're appointed by the president, need Senate approval, and each serves a 6-year term.
Staggered terms, presume.
Yes, typically staggered. And a critical safeguard here is that no more than 2 members of the board can be from the same political party. This helps promote bipartisan decision-making, independent thought, keeping the focus on regulation, not politics. The president also designates 1 member as the chairman. When it comes to who gets appointed, the appointment criteria give preference to individuals who, through education, training, or experience, are especially qualified in financial services, regulation, or policy.
So they need expertise.
Definitely. They want experts running the show. What's also crucial is a specific limitation. Generally, not more than 1 board member can be appointed from individuals who, at the time of appointment, are, or were recently, directly involved with an insured credit union, like a committee member, director, officer, employee.
To avoid conflicts of interest.
Exactly. It aims to prevent those conflicts and maintain impartiality in regulation. That's vital for consumer protection and the integrity of the whole system. The board's responsibilities are extensive. They manage the administration, they adopt rules for its operations, keep permanent records, report annually to the President and Congress on activities and financial programs. The chairman's role is specific. Act as the main spokesperson, represent the NCUA in official relations, determine each board member's area of responsibility, and direct the implementation of the board's policies. And for accountability. The NCUA's own financial transactions are audited by the General Accounting Office using standard corporate principles. This whole structure is designed for independent oversight and expertise, laying the groundwork for a regulated, reliable credit union system.
That structure clearly emphasizes independence and expertise. That limitation on prior credit union affiliation seems key for impartiality. So, okay, we have the regulator. How does a federal credit union actually come into existence? How does it operate? Let's trace that life cycle from getting the charter to its day-to-day functions.
Understanding that life cycle really shows the meticulous design. It all starts with the organization and approval process. For a group to form a federal credit union, they first prepare an organization certificate.
Like the birth certificate.
Kind of, yeah. It's their founding document. It details crucial things. The proposed name, the location of the main office, the initial par value of shares, and very importantly, its field of membership. Who exactly can join? They can even set it up to exist perpetually, showing a long-term commitment. This certificate then goes to the NCUA board for approval. But it's far from just a rubber stamp.
No kidding.
Before approving anything, the board conducts an appropriate investigation. This investigation checks three main things. First, does the certificate follow all the rules of the Act? Second, what's the general character and fitness of the founders? Are they trustworthy, capable?
Makes sense.
And third, they determine the economic advisability of setting up this new credit union. Does the community or group actually need it? Does it have a viable plan to succeed? Only after the board approves does this certificate become the official charter, giving the credit union corporate status and its powers.
It's fascinating how carefully thought out that initial approval is, ensuring only viable, well-managed entities get started. So once they're up and running, how does the NCUA actually fund its operations? All this examination and supervision doesn't come from taxpayer money, does it?
You're exactly right. It's largely self-sustaining. That's a key feature of financial regulation in the U.S. The Act details the operating fees credit unions pay. Every federal credit union has to pay an annual operating fee to the NCUA. This fee might be one charge or several, depending on what function it's funding.
Okay.
The fee schedule itself. The board determines it. And they carefully consider the NCUA's expenses, what it costs them to do their job, but also, importantly, the ability of the federal credit unions to actually pay the fee.
So it's scaled somehow.
It considers ability to pay, yes. There are also provisions for waivers. For instance, a brand new credit union might not pay a supervision charge in its very first year, or a credit union that's winding down operations might be exempt. All these operating fees, they're deposited directly with the U.S. Treasury and used by the board to cover the expenses of carrying out the Act. That includes examining and supervising the federal credit unions. So you're right, it's a truly self-sustaining model. The credit unions themselves fund the oversight that ensures their stability and trustworthiness for members.
That's a crucial distinction, making the system accountable to itself.
Right.
Okay, so a federal credit union is chartered, it's paying for its own oversight. What exactly are its powers? What can it do for its members and in the wider financial world? It sounds like the Act gives them a pretty comprehensive list.
It absolutely does. The Act lays out a remarkably broad set of authorities. These allow credit unions to function as full-service financial institutions while still sticking to their unique cooperative principles. At a basic level, they have general powers. Make contracts, sue and be sued. Adopt an official seal, buy, hold, and sell property needed for operations. Pretty standard stuff for any corporation.
Right, the basics.
Where it gets really specific is in their lending to members. This is their core function, right? They can make general loans, usually with maturities up to 15 years. But for residential real estate loans, think mortgages on a primary home, secured by a first limit for ROMI, the maturity can go up to 30 years, or other limits the board sets.
Standard mortgage term.
Exactly. These loans have to follow criteria set by the credit union's own board. Interest rates are regulated too. They can be up to 1% above the Fed's discount rate for short-term commercial loans, or the rate allowed by state law, whichever is higher, and there's a strict penalty for charging too much. Knowingly doing so means forfeiting all the interest, and the borrower can get back twice the interest they paid within 2 years.
Strong deterrent.
Very strong. And a key member protection. Borrowers can repay their loan early, fully or partially on any business day without penalty. There are only very limited exceptions for partial prepayments on mortgages. All loans have to be paid or amortized according to board rules, considering the borrower's needs. Loan approval. That falls to a credit committee or a loan officer. But here's a crucial risk control. No loan can be made if it would make that member's total debt to the credit union exceed 10% of the credit union's unimpaired capital and surplus.
Ah, the 10% rule.
Yes, basically 10% of its total financial reserves. This stops them putting too much risk on one single borrower. Beyond individual loans, they can offer lines of credit, the self-replenishing kind. They also have power to make loans to other entities specifically, other credit unions and approved credit union organizations, though these need board approval and are usually capped at a small percentage of the lender's capital. In terms of types of accounts, they can issue shares with varying dividend rates, share certificates like CDs with different rates and maturities, and share draft accounts, essentially, checking accounts, all subject to terms set by their board within NCUA limits.
So savings, checking, CDs, the usual suspect.
Right. And investments are carefully outlined too. They can invest in very safe things like U.S. government obligations or securities fully guaranteed by the U.S. They can also invest in loans to other credit unions and in shares or accounts of other federally insured financial institutions. Their options extend to obligations from government-sponsored entities like Fannie Mae and Freddie Mac. Importantly, they can invest in organizations that provide services related to routine credit union operations.
Like tech providers.
Exactly, and this is key. This power explicitly does not include acquiring control of other financial institutions, nor investing in insurance companies or trade associations. It keeps them focused on their core mission. Borrowing is allowed up to 50% of their capital and surplus, with some exceptions if the board authorizes more for specific purposes. They offer various other services, like levying late charges, cashing checks and money orders for members, buying or selling eligible loans of their members, even buying or selling assets from other credit unions, all subject to regulation. And then there are what you might call unique powers. For instance, investing in certain mortgage-backed and small business-related securities. And perhaps surprisingly, the Act specifically allows them to provide technical assistance to credit unions in places like Poland and Hungary.
Really? Poland and Hungary.
Yeah, it reflects a historical effort to promote cooperative credit internationally, particularly after the fall of communism. Finally, they have incidental powers, basically, whatever else is necessary to carry on their business. This broad range shows how credit unions, while different from banks, are full-service institutions. Those specific limits, like the 10% cap per member, are crucial for managing risk and keeping member funds safe.
That's a truly comprehensive list, much broader than some might think. That 10% cap is clearly crucial for risk management. Speaking of loans, the Act carves out that very specific category, member business loans, or MBLs. This sounds incredibly important for understanding how credit unions support small businesses.
It is, and it really reflects a careful balancing act in regulation. This section on the limitation on member business loans, MBLs, sets out specific parameters. Generally, an insured credit union can't make an MBL if it would push their total outstanding MBLs over a certain cap.
A limit on total business lending.
Exactly, and that cap is usually tied to its net worth. It's designed to make sure that credit unions, while supporting small businesses, don't concentrate too much of their lending in potentially riskier commercial ventures relative to their capital base. It's a key prudential limit. However, there are important exemptions from this limit. The cap doesn't apply to a few types of credit unions, ones specifically chartered for making MBLs, or that have a history of primarily making them. Credit unions that serve predominantly low-income members, or those designated as Community Development Financial Institutions, CDFIs.
So exceptions for those with a specific mission there.
Right. These exemptions acknowledge the specialized missions of certain credit unions focused on business lending or serving underserved communities. The definition of member business loan itself is key. It's basically any loan, line of credit, or letter of credit used for a commercial, corporate, or other business investment property or venture or agricultural purpose. Pretty broad. But importantly, the definition also says what's not an MBL. This includes loans fully secured by a lien on a 1-to-4 family dwelling, your typical home mortgage. Loans fully secured by shares in the credit union or deposits elsewhere, very low risk. Small loans, specifically those under $50,000 total for a borrower. This allows for small personal or micro-business loans without hitting the MBL cap, loans fully insured or guaranteed by a government agency, and loans from a corporate credit union, which serve other CUs, to another credit union.
Okay, so quite a few exclusions there.
Yes. For MBL purposes, net worth generally means the credit union's retained earnings, the profits they've kept over time. For low-income credit unions, it can also include certain types of secondary capital. And finally, the Act mandates compliance. Credit unions over the limit when this section was enacted had 3 years to get back under it. The NCUA works closely with state regulators on implementing this.
This section is incredibly important for understanding the scope of credit union lending, especially to small businesses. It really shows how regulators try to balance providing credit access with prudent risk management. It's clear that while credit unions are about people, they're still highly structured. So let's look at the governance, membership, and member protections that define that cooperative nature, starting with the very first rules they set up.
Indeed. These foundational elements of governance and membership really underscore the cooperative identity. The Act addresses bylaws, saying the NCUA board provides standard forms for the organizational certificate and bylaws. This simplifies things for new credit unions. Incorporators submit their proposed bylaws for approval, making sure internal rules align with federal standards. The rules for membership are particularly significant. They define who can join and how that cooperative bond is maintained. Generally, membership includes the founders and others elected to join. Each member has to subscribe to at least one share and pay an initial fee. While shares can be held jointly, a crucial detail is that joint account holders usually can't vote, get loans, or hold office unless they also qualify as members themselves.
So being on the account isn't enough for governance rights.
Not usually, no. It reinforces that individual membership principle. The Act meticulously defines membership field categories based on the common bond idea. 1. Single common bond. Limited to one group with a shared connection, employees of a company, members of an association, that sort of thing. 2. Multiple common bond. Can serve more than one group, where each group has its own common bond. Generally, each group has to have fewer than 3,000 members when first included, with some exceptions if a group can't realistically form its own credit union. This allows CUs to serve diverse communities while keeping the common bond idea at the group level. 3. Community credit union. Membership is open to people or organizations within a well-defined local community, neighborhood, or rural district.
So occupation, association, or geography, basically.
Yep, those are the main categories, yes. The Act also includes important exceptions and provisions. Grandfathering. People or groups who were members before the Credit Union Membership Access Act of 1998 can generally stay members. Underserved areas. Multiple common bond CUs can add members from local communities designated as investment areas and underserved by banks if the CU sets up a local office there. This promotes financial inclusion. Immediate family household. Eligibility extends to immediate family or household members of eligible persons. Membership retention. Usually once you're a member, you stay a member until you choose to leave, unless expelled for cause. It emphasizes that lasting cooperative relationship. Regarding expansion criteria, the board generally encourages forming new, separate credit unions over just expanding existing multiple common bond ones if practical. For approved expansions, the board looks at the existing CU's financial health, funding, ability to serve the new group, and whether the public benefit outweighs potential harm to other CUs. The common bond rule really defines a credit union, but this flexibility shows adaptation, balancing the cooperative principle with broader service access.
That makes the common bond concept much clearer. It's not as rigid as it might sound, and it adapts. Now, for the members themselves, how do they participate in governing their credit union? What about meetings and voting?
Right. The Act outlines members' meetings and voting, which are fundamental to that cooperative democratic nature. First, it sets the fiscal year end for all federal CUs as December 31st. Annual meetings are held, as the bylaws say, and special meetings can be called too. Now, a truly distinguishing feature enshrined here is the voting rule. No member shall be entitled to vote by proxy.
No proxy voting, that's huge.
It is. It emphasizes direct member participation. Unlike a typical corporation where shareholders often vote by proxy, while an organizational member, like a business, might vote through an agent, the core idea is direct engagement. Furthermore, and this is critical to the cooperative identity, irrespective of the number of shares held, no member shall have more than one vote.
One member, one vote.
Exactly. It reinforces that philosophy. Control is spread equally among members, not based on how much money you have invested, which is typical in shareholder-owned banks. It's a key principle that sets credit unions apart and highlights their member-driven focus.
That one member, one vote rule really drives home the cooperative difference.
So beyond the members, how is the credit union actually managed day to day? What's the management structure look like?
The Act spells out the management structure. It clarifies the key bodies responsible for oversight and operations. At its core, A federal credit union is managed by a board of directors, a supervisory committee, and if the bylaws allow it, a credit committee. The board of directors must have an odd number of directors, at least 5. They're elected annually by and from the members according to the bylaws. If a vacancy happens, the remaining directors appoint someone to fill it until the next election, ensuring continuous governance. The supervisory committee is appointed by the board with 3 to 5 members. Importantly, only one of them can also be a director, and that director can't be a compensated officer of the board. Separation for independent oversight.
Precisely. It's a crucial internal check and balance. A record of all executive officers and committee members' names and addresses has to be filed with the NCUA quickly after they're elected or appointed, ensuring transparency for the regulator. Finally, a unique aspect reinforcing that nonprofit, member-focused mission is the rule on compensation. No member of the board or any other committee can be compensated as such. The only exceptions are for reasonable health insurance type protection and reimbursement for reasonable expenses incurred doing their duties.
So mostly volunteers.
Mostly volunteers at the board and committee level. It underscores that volunteer-driven nature, highlighting their commitment to the cooperative without personal financial gain for their oversight role.
That volunteer leadership is a powerful indicator of their member-first philosophy. So the board and committees are in place. But who actually runs the daily operations? What about the officers of the board?
Good question. After the annual members' meeting, the directors elect the officers of the board from among themselves, as the bylaws specify. The Act clarifies that generally only one board officer may be compensated as an officer. The bylaws have to name this position and outline the duties of each officer.
Okay, so one paid leader allowed.
Typically, yes. It reinforces the volunteer nature of most board roles while allowing for professional, paid leadership in key operational positions. Additionally, the board must elect a financial officer from their number. This person is responsible for ensuring adequate fidelity coverage, basically, insurance against fraud or misuse of funds for everyone handling money. This is done according to NCUA regulations.
A critical safeguard.
Absolutely. Protects the credit union's assets and members' funds from potential dishonesty.
That makes sense, balancing volunteerism with professional safeguards. And now we arrive at the core section that the proposed Credit Union Board Modernization Act aims to change: the original powers and duties of the board of directors. This really shows the extensive responsibilities they have. They're not just rubber stamping things, they're deeply involved.
Precisely. This section is incredibly comprehensive. It shows the granular level of oversight expected from a credit union's board. Originally, the section mandated that the board shall meet at least once a month and shall have the general direction and control of the affairs of the federal credit union.
That specific monthly mandate.
That was the exact clause the Modernization Act targets. Shifting from that blanket rule to the tiered system we discussed, adapting to the credit union's health. Beyond just meeting frequency, the Act outlines a wide array of key duties for the board. These are paramount for sound operation and member protection. They have to act on membership applications or appoint officers to do it. Fundamental for maintaining the common bond. They're responsible for providing adequate fidelity coverage for officers and employees handling funds. A crucial internal control. The board fills vacancies on its own ranks until the next election, and also on the credit committee if there is one. They appoint the members of the supervisory committee and, if bylaws allow, the credit committee. If bylaws permit, they can appoint an executive committee, at least 3 directors, to act on its behalf, and other committees too, setting their limitations. Allows for delegation. They're required to review at each meeting a list of approved or pending membership applications. Oversight on who joins. They must provide written reasons for denying membership if the applicant requests it, transparency, and fairness. If there's no credit committee, the board has to review loan applications denied by a loan officer if the member requests in writing, an appeals process. They declare the dividend rate paid on shares and accounts, managing member returns. They must establish and maintain a system of internal controls consistent with board regulations, essential for operational integrity. They're responsible for establishing lending policies, guiding the core business. Finally, they can do all other things that are necessary and proper to carry out the credit union's purpose and powers within regulations. Broad flexibility.
Wow, that gives a clear picture of just how extensive the board's responsibilities are. They're really involved in the strategic and operational health. This context truly highlights why changing their meeting frequency is significant, moving from that rigid monthly check-in to a more dynamic, needs-based approach for efficient governance. Now, beyond the board, what about those other committees, the credit committee and the supervisory committee? What are their distinct roles?
That's a great follow-up. These committees further define the internal governance and those checks and balances. The Act details the credit committee. If the bylaws provide for one, it can be appointed by the board or elected by the members. It needs an odd number of members, and no more than one loan officer can serve on it. The credit committee meets as often as needed, but at least monthly, to consider loan applications. Approval usually needs a majority vote with a quorum present. The committee also has the important power to appoint and delegate approval authority to loan officers, which streamlines lending for routine requests while keeping oversight for complex ones.
Okay, so focused on lending decisions.
Right. Then, perhaps even more critical for member protection is the supervisory committee. This committee acts as a vital internal check directly serving member interests, their main duty. To conduct or arrange for an annual audit and report on it to the board, plus a summary to the members at the annual meeting. They can also order extra audits if needed, or if the NCUA orders it, adding layers of financial scrutiny. The Supervisory Committee also has significant oversight powers. By a unanimous vote, they can suspend any officer, credit committee member, or even a board director.
Suspend them.
Wow. Yes. That suspension then has to be acted upon by the members at a meeting held shortly after, usually within 2 weeks. It's a powerful tool for immediate concerns about conduct or finances. By a majority vote, they can also call a special members meeting to address violations of the Act, Charter, bylaws, or any unsafe practices. Conversely, the board can suspend supervisory committee members, also subject to member action. Finally, the supervisory committee must verify member accounts against the treasurer's records periodically, at least every 2 years. Directly safeguarding member funds and ensuring record accuracy, it really is the eyes and ears for members on financial integrity and compliance.
That's a significant layer of protection, knowing there's a committee focused on audits and oversight. Beyond those committees, what about financial returns for members? How are dividends handled?
The Act addresses dividends. It says that at intervals the board authorizes, and after setting aside required reserves, the board can declare a dividend. Importantly, this dividend can be paid at different rates on different types of shares, different rates and maturities for share certificates, and different rates on different types of share draft accounts.
Flexibility there.
Exactly. It lets credit unions offer competitive and varied products, tailoring returns. If the par value of a share is over $5, dividends must be paid on all funds in the regular share account once a full share is bought. This ensures members benefit from participating and investing.
That's great for members. But what if a member causes problems? Can a credit union actually kick someone out? Expel a member? And if so, what's that process?
Yes, a member can be expelled, but the process is highly regulated to protect their rights. The Act outlines expulsion for cause. A member can be expelled by a 2/3 vote of a quorum of directors, but only following a specific policy adopted by the NCUA board, designed to ensure fairness. The procedure is quite detailed. First, the member must be notified in advance about the pending expulsion and the specific reason. This notice can be in person, by mail, or electronically if they've agreed to that.
Okay, they have to be told why.
Absolutely. Then, the member has 60 days to request a hearing from the board. If they don't request one within 60 days, they're expelled. If they do request a hearing, the board has to provide one, hold it, and then vote on the expulsion afterwards. Notice of the final decision is then given. An expelled member isn't permanently banned, though. They can request reinstatement and can be reinstated by a majority vote of either the directors or the members at a meeting. Interestingly, the Act says nothing requires the expelled member be allowed to attend that reinstatement meeting in person. The definition of cause is clear: a substantial or repeated violation of the membership agreement. And here's a super important caveat that underscores the cooperative principle. Expulsions must be individual, case by case. Neither the board nor any credit union can expel a whole class of members.
No group expulsions.
Right. It ensures the process targets specific problematic behavior, not entire groups.
That shows that while CUs are member-focused, there are clear rules for maintaining integrity and smooth operation, even if it means expelling someone for defined reasons, all while protecting their rights. And quickly, what about minors? Can kids have accounts?
Yes, the Act explicitly says shares can be issued in a minor's name or in trust, subject to conditions in the bylaws. If shares are in trust, the beneficiary's name must be disclosed. This ensures clarity and proper management for younger members or those with beneficiaries, broadening access.
Good inclusion for accessibility. Now, let's talk about the NCUA's broad powers beyond these basic operational rules. They're the ultimate authority. What kind of overall regulatory and enforcement muscle do they have?
The NCUA's powers definitely extend far beyond setting meeting frequencies or approving bylaws. The Act grants the board significant general regulatory authority over the entire federal credit union system. The board can prescribe rules and regulations for administering the whole Act. This includes complex actions like mergers, consolidations, dissolutions. It means they can create detailed guidelines for pretty much every aspect of a credit union's operation, ensuring consistency. In terms of enforcement, the board has the ultimate authority to suspend or revoke the charter of any federal credit union or place it in involuntary liquidation. They do this if they find the organization is bankrupt, insolvent, or has violated its charter, bylaws, the Act, or regulations. They can also step in if a voluntary liquidation isn't being handled properly and force an involuntary one, appointing their own agent.
So they can take over if needed.
Yes. The liquidation process is detailed. The liquidating agent, often NCUA, notifies creditors and members, collects claims, distributes funds. For smaller liquidations or bad books, they can do no publication liquidations. The credit union's corporate existence continues for 3 years after charter cancellation for winding up affairs. Records can be destroyed after 5 years. The board can also delegate functions to staff or even supervised institutions, allowing for efficient management. All books and reports must follow board-approved forms for uniformity. Beyond direct regulation, the NCUA is authorized for research and education. They can study credit problems for persons of small means and cooperative saving lending. They can fund training for CU operators and consumer counseling, especially for the poor. Reflects that broader social mission.
Right, not just rules, but support too.
Exactly. And they mandate fidelity bonds, requiring anyone handling money to have bond coverage against loss from fraud, dishonesty, embezzlement, etc. The board approves the bond forms and amounts. Finally, the board has significant authority over its own personnel and funding. They appoint staff, enter contracts, acquire property. Employee pay aims for comparability with other federal bank regulators. Crucially, salaries and expenses are paid from fees and assessments on insured credit unions, reinforcing that self-sustaining nature.
That truly paints a picture of the NCUA as a powerful, self-funded regulator with extensive reach. Not just day-to-day operations, but purpose and education too. A comprehensive steward. And it sounds like there are broader implications for how CUs fit into the nation's financial infrastructure, beyond just their members. What about their role as fiscal agents and their tax status?
That's right. The Act outlines the fiscal agent and tax status of federal credit unions, cementing their unique role. Each federal CU, when the Treasury Secretary asks, must act as a fiscal agent of the United States.
Meaning what, exactly?
Meaning they perform services like collecting taxes, handling government bonds, assisting in federal lending and borrowing. If designated, they can also be depositories for public money, except customs receipts. They can pledge assets as security for government deposits, too. This integration into federal financial operations highlights their public trust. Now, taxation. This is a significant advantage. Federal credit unions organized under the Act their property with exceptions. Franchises, capital reserves, surpluses, income are exempt from all taxation by the U.S. or any state, territorial, or local authority.
Wow, broad exemption.
It is a cornerstone of the model, reflecting their nonprofit, cooperative nature. The exceptions are key. Real property and tangible personal property are subject to normal taxes. And while the CU itself is exempt, the Act clarifies that holdings by individuals in a federal CU can be included in valuing their personal property for state local taxes. But the CU isn't responsible for collecting that tax. This dual status, institutionally tax-exempt, but individual holdings taxable, is defining.
That tax exemption, plus being fiscal agents, clearly positions CUs differently from banks, solidifies their public utility. Speaking of which, I saw surprising detail about physical presence. Can CUs use federal buildings?
Yes, the Act allows for space in federal buildings. Upon application, the government agency responsible for federal building space can, at their discretion, lease land or allot space to a state or federal credit union. Crucially, this can be without charge for rent or services if at least 95% of the CU's membership served there are current or former federal employees and their families, and if space is available.
Free rent and utilities.
Pretty much. Services broadly includes lighting, heating, cooling, furniture, phones, security. It shows that unique relationship, particularly for CUs serving federal employees.
That's a unique perk. And what about charter flexibility? Can they switch between federal and state charters?
The Act directly addresses conversions. It outlines the process for a federal CU to convert to a state CU by complying with specific rules, and vice versa for a state CU to convert to federal. In both cases, board approval is required. For instance, converting from state to federal. The NCUA board must be satisfied all Act requirements are met before approving the certificate. Upon approval, the state CU becomes a federal CU, taking on all assets and liabilities seamlessly. Ensures transition while maintaining oversight.
Good to know there's flexibility with oversight. And here's a modern touch I noticed. What about public data from the NCUA? Is it easily available?
Yes, a crucial modern requirement. Open data publication. It mandates all public data assets published by the NCUA be available as open government data assets, meaning freely downloadable, human-readable, and accessible via an API where appropriate. It's a forward-thinking provision, promoting transparency and accessibility. Important in today's digital age for researchers, policymakers, and the public to understand the CU system's health.
Very forward-thinking, speaks to transparency. Now let's turn to maybe the most critical protection for members. Share insurance. This is what really safeguards your money in a credit union. How does that system work?
This section is absolutely fundamental. Share insurance, protecting your money. It establishes the insurance of member accounts and eligibility. It mandates the NCUA board shall insure member accounts of all federal CUs. It also says the board may insure state CU accounts if they meet requirements. Discretionary for state CUs. To become or remain insured, there are specific requirements for insured credit unions. Allow board exams and pay for them. Provide protection against losses like burglary or defalcation, misuse of funds. Maintain required reserves. Use board-approved account forms. And crucially, pay and maintain the required deposit with the fund and pay insurance premiums. When approving insurance applications, the board looks at history, financial condition, management, economic advisability, risk to the fund, and character fitness of management. What's interesting is the prohibition on government-sponsored enterprise, GSE, sponsorship. Generally, an insured CU can't be sponsored by or accept financial support from a GSE, like Fannie Mae or Freddie Mac, if the CU includes the GSE's customers in its field of membership.
Why is that?
It aims to ensure the CU's primary purpose stays focused on its defined membership and community, not driven by external corporate interests or potential conflicts with the GSE's mission. There are exceptions for routine business financing and employee CUs of the GSE. It's about maintaining independence and member focus.
That GSE sponsorship rule really ensures focus on the defined membership. So they have to pay to be insured. How does that funding happen, and how do they report their financial health?
Precisely. The Act lays out ongoing obligations. Insured CUs must submit reports of condition to the board on selected dates, detailing financials, including total insured shares. These reports must be certified as true and correct. The board can ask for other reports too, and there are significant penalties for late, false, or misleading reports. Thousands, potentially millions daily, depending on severity. Underscores the seriousness of accurate reporting. The board can also require audits. If a CU hasn't had a satisfactory annual audit or has persistent and serious record-keeping deficiencies, the board can require an outside, independent CPA audit. For larger CUs, $500 million plus in assets, an annual independent audit is mandatory. CUs must give auditors their condition reports and exam reports. The board can also engage in data sharing of exam info with other agencies, CU officers, receivers, etc. Key to funding the insurance is the insurance deposit. Each insured CU must keep a deposit with the National Credit Union Share Insurance Fund, and CUSSF, equal to 1% of its insured shares, adjusted periodically. This deposit is returned if insurance ends, unless they liquidate due to insolvency.
Okay, a 1% deposit.
Yes. And on top of that, the board can assess insurance premium charges up to twice a year. If the NCUSIF's equity ratio, its financial health measure, falls below 1.3% to restore it. If it falls below 1.2%, a premium charge is mandatory. These charges are a percentage of insured shares, same for all CUs. If the equity ratio is projected to fall or does fall below 1.2%, the board must create and implement a fund restoration plan within 90 days, aiming to restore it within 8 years. These plans must be published.
Transparency again.
Exactly. Conversely, if the fund is healthy, the board must make distributions from the fund back to CUs. This happens annually if government loans are repaid and the equity ratio is above its normal operating level, 1.2%, 1.5%. Excess funds go back. To backstop everything, the NCUSF can borrow up to $6 billion from the U.S. Treasury if needed. Finally, there are penalties for failing to pay deposits premiums or filing false statements, including fines and potentially losing their charter. CUs can't pay dividends if they're in default. Records must be kept for 5 years. It's not just about covering losses, it's a proactive system of monitoring and intervention to maintain confidence and keep CUs sound.
That's a robust system. Proactive monitoring and intervention. So this fund, the NCUSF, how's it managed? What's its primary function?
The National Credit Union Share Insurance Fund, NCUSF, detailed in the Act, is that central pillar of deposit protection. It's created in the Treasury as a revolving fund, specifically for insurance purposes. Money in this fund is available for several key uses, making insurance payments to members of failed CUs, providing assistance and covering expenses during liquidations or threatened liquidations, and administrative costs. All deposits, premiums, exam fees, penalties collected go into the NCUSF. The board reports annually to Congress on the fund's health, including results of an independent audit. Ensures transparency. Besides borrowing from the Treasury, the fund can also borrow from the National Credit Union Central Liquidity Facility, another liquidity backstop.
So the NCUSF is the big safety net. How does the NCUA actually keep tabs on CUs to make sure they stay healthy and don't drain this fund?
That's where the examination of insured credit unions comes in. The NCUA board appoints examiners with power to thoroughly examine any insured CU, any CU applying for insurance, or any closed insured CU. Exams happen whenever the board thinks necessary to check the CU's condition for insurance purposes. Examiners investigate all affairs, submit full reports. Claim agents investigate insured account claims, can administer oaths, issue subpoenas. Beyond individual exams, the board has broader liquidity responsibilities. They must periodically assess potential liquidity needs of each insured CU individually and their options. They also assess potential liquidity needs of CUs as a group and system-wide options. To help CUs access liquidity, the board shares relevant info like exam reports with the Federal Reserve banks with confidentiality safeguards. This direct line allows better coordination for system-wide stability and liquidity support when needed.
Sounds like a thorough system of checks, internally and externally. Now, let's get into the nitty-gritty of what's required of an insured CU and what happens when things go wrong, from logos to mergers to banning bad actors.
This is where requirements governing insured credit unions comes in. Covers a wide array of operational and compliance standards insured CUs must follow. First, the insurance logo. Each insured CU has to display a sign at all business places saying, "Insured share accounts are backed by the full faith and credit of the United States government." Immediate assurance for members. Penalties for violations.
Gotta show the sign.
Gotta show the sign. Next, mergers and conversions. Generally, no insured CU can merge or consolidate with another or acquire assets assumed liabilities without prior board approval. However, an interesting provision lets an insured CU convert to a mutual savings bank or savings association without prior board approval if they hold a member vote and follow notification rules. Importantly, directors and senior management can't get golden parachute benefits from such a conversion beyond normal pay. NCUA has to create conversion rules consistent with other regulators. The Act also covers a crucial prohibition on convicted persons, maintaining leadership integrity. Generally, anyone convicted of a crime involving dishonesty or breach of trust or entering a similar pretrial program cannot become or stay an institution-affiliated party, director, officer, employee, or participate in CU affairs without prior written board consent.
So background checks are key. Absolutely. For certain severe offenses, fraud, money laundering, there's a minimum 10-year ban before consent can even be considered, unless a court makes an exception. There are exceptions, though. Maybe if many years have passed, or for minor de minimis offenses after a year. The board must accept consent applications for individuals seeking permission, considering rehabilitation evidence, age at conviction, time elapsed, work history, recommendations. FBI records are primary, applicants can review them. Approved consents might allow work for the same employer unless security duties change significantly. NCUA coordinates with FDIC for consistency. The Act also requires the board to set security devices standards for CUs, minimums to deter crime, aid apprehension. It formally authorizes shared draft accounts, checking, and paying dividends on them. Limited to individuals, nonprofits, public funds. A key power, interest rate preemption. Lets insured CUs charge interest up to 1% above the Fed's discount rate, overriding state usury laws if that's higher. Provides flexibility, but illegal rates bring penalties. Finally, the Act gives the board authority for assistance for troubled CUs. They can authorize mergers or asset purchases liability assumptions for insolvent or in danger of insolvency CUs with other insured CUs to protect the fund and members, ensure stability.
That's a lot for insured CUs to cover. Clear NCUA has a firm grip. But what if CUs or their people don't follow the rules? How does NCUA enforce these? What actions can they take?
That brings us to enforcement actions. Keeping CUs in line. This gives the NCUA board extensive powers to address non-compliance and protect the system, termination of insurance. State CUs can voluntarily end insurance, but the board can involuntarily terminate for unsafe, unsound practices, violations, or unsafe condition. Requires notice, chance to correct, hearing. If terminated, accounts stay insured for a year. Cease and desist orders, a powerful tool, orders CUs or institution-affiliated parties, officers, directors, etc., to stop unsafe practices or violations. Can also mandate affirmative action. Restitution, growth limits requiring qualified staff. Temporary cease and desist orders, issued if a violation practice is likely to cause insolvency or significant asset loss. Immediately effective and enforceable while full proceedings happen. Removal and prohibition. Board can remove or prohibit affiliated parties from CU affairs if they commit violations causing loss, prejudice members, or result in personal gain and involve dishonesty or unfitness. Specific rules for money laundering. Suspension orders. Pending full removal, board can suspend individuals if needed to protect the CU or members. Industry-wide prohibition. Individuals removed prohibited by NCUA are generally barred from any insured depository institution. Banks, thrifts, other CUs, broad deterrent, involuntary possession, conservatorship, liquidation, most severe action. Board takes control under conditions like unsafe practices, insolvency, or being significantly or critically undercapitalized. We'll define this soon. For state CUs, state approval usually needed, but board can proceed without it in some cases. Civil money penalties, tiered. General violations, thousands day. Reckless conduct, personal gain, tens of thousands day. Knowing reckless violations causing substantial loss, up to $1 a day for individuals, or 101% total assets per day for the CECU. Mitigating factors considered. Jurisdiction. Federal courts enforce board orders. Post-separation jurisdiction. Board retains power to act against former affiliated parties for up to 6 years after they leave. Ensures accountability. BASML compliance. Board mandates anti-money laundering cash reporting procedures, examines for compliance, issues orders for failures, public disclosure, generally required to publish agreements and final enforcement orders monthly. Hearings usually public, with exceptions. Promotes transparency. Golden parachutes indemnification. Board can ban or limit golden parachute payments tied to termination when CU is troubled, and indemnification payments if conditions like fraud exist. Foreign investigations. Board can request provide assistance from SOMRO foreign banking authorities. 1-year examiner restriction. Senior NCUA examiners can't take pay from a CU they examined in their final 12 months for 1 year after leaving NCUA. Penalties include industry bans.
This comprehensive enforcement framework shows the rigorous regulatory environment. A layered system to detect and correct problems early, protecting members and the system. Truly about prevention, not just reaction. And it sounds like this oversight extends even to entities closely connected to the CU.
Yes, the reach is quite broad. The Act explicitly details oversight of affiliates. It says a credit union organization, like service providers, is subject to NCUA examination and regulation, just like the insured CU itself, even if services are off-site or by contract.
Closes loopholes.
Exactly. Ensures critical functions, even outsourced, get the same scrutiny, don't become avenues for risk or non-compliance.
That's crucial. Now, the ultimate consequence of severe trouble, liquidation and paying insurance.
Yeah.
How does NCUA handle these situations to protect members?
This is covered in payment of insurance and conservatorship, where the rubber meets the road for member protection. Liquidation triggers. Board can close a federal CU for liquidation, appointing itself agent, if it's bankrupt insolvent. Also, if it's significantly or critically undercapitalized, PCA terms coming up, with no reasonable prospect of recovery. Allows early intervention. Liquidating agent powers. Board takes over all rights powers. Can operate the CU, sell assets, pay valid obligations. Expenses paid from CU funds. Claims process. Agent determines claims, publishes notices, sets up review procedures, including alternative dispute resolution. Repudiation of contracts, a significant power. Conservator liquidator can repudiate, cancel burdensome contracts if it helps orderly administration. Damage claims are limited. Special rules for leases, real estate, and complex qualified financial contracts, securities, swaps, etc. They get some netting protections but face temporary stays. Allows strategic liability management. Payment of insured deposits. Board pays insured deposits as soon as possible, either cash or transferring the deposit to a new and other insured CU. Standard max is $250,000, inflation adjusted. Your funds are fully backed within this limit. Aggregation. All accounts a member holds for their own benefit are added together for the insurance limit. Special coverage. Government deposits, pension profit sharing, IRA funds are insured up to the standard max per account per beneficiary. Employee benefit plans, IOLTAs, lawyer trust accounts, similar escrows also get pass-through coverage to beneficiaries. Subrogation. When board pays insurance, it steps into the account holder's shoes, gaining their claims against the CU up to the payment amount. Liability of directors' officers can be held personally liable for damages in board actions for gross negligence or greater disregard of duty, including intentional misconduct, per state law. Prohibition on convicted debtors. Individuals convicted of certain crimes affecting a CU can't buy assets from it if the board is conservator liquidator and they owe money, have claims against them.
Incredibly reassuring for members. Funds are thoroughly protected, clear accountability for leaders, a robust system. But beyond reacting to problems, what mechanisms prevent CUs from getting into deep trouble initially?
That's where prompt corrective action, PCA, the early warning system, comes in. Its explicit goal: resolve the problems of insured credit unions at the least possible long-term loss to the fund by taking prompt corrective action. The board must prescribe a PCA system consistent with banking standards, but crucially, tailored for CU's unique cooperative structure, nonprofit, no capital stock, rely on retained earnings, volunteer boards. There's even a separate PCA system for new credit unions, under 10 years old, and under $10 assets, giving them reasonable time to build net worth.
Okay, so tailored PCA. How does it work?
The heart is its net worth categories. A critical traffic light system. Well-capitalized, net worth ratio 7% plus RL. Healthiest CUs, adequately capitalized. Net worth ratio 6% plus R, generally sound, undercapitalized. Net worth ratio less than 6%. Triggers initial interventions, significantly undercapitalized. Net worth ratio less than 4% or R less than 5% if they fail to implement an acceptable net worth restoration plan. More serious issues. Critically undercapitalized. Net worth ratio less than 2% or higher up to 3% if board specifies. The red light, severe distress. For complex CUs, there's also a risk-based net worth requirement for risks not covered by the basic ratio. When a CU is undercapitalized, it faces an earnings retention requirement. Must set aside at least 0.4% of total assets annually as net worth. Board can lower this to avoid massive share withdrawals. They also need a net worth restoration plan realistic, likely to succeed. Board helps small CUs prepare these.
Restrictions kick in too.
Yes. Restrictions on undercapitalized CUs generally can't increase average total assets, unless part of an approved plan, or increase MBLs until adequately capitalized. For critically undercapitalized CUs, actions are much tougher. Within 90 days, board must appoint conservator liquidator, unless it documents why another action is better. If still critically undercapitalized after 18 months, liquidation is generally required, unless specific exceptions apply. Substantial compliance with plan, positive earnings, certified viable. Finally, for regulator accountability, if the NCUSIF incurs a material loss, 25 members or 10% assets, from a CU, the NCUA's Inspector General must review the supervision and make the report public. This section is the heart of preventative regulation. Traffic light system green to red, increasing intervention. Underscores NCUA's commitment to protecting deposits and system stability.
That traffic light system makes perfect sense for stability, catching problems early. And in times of widespread financial stress, there's another crucial layer, especially for the CUs serving other CUs, right? The Temporary Corporate Credit Union Stabilization Fund.
That's right. The Temporary Corporate Credit Union Stabilization Fund was a critical response to past challenges. A separate temporary buffer specifically for the corporate credit union system.
Corporates being the CUs for CUs.
Exactly. This fund was established in the Treasury, run by the NCUA board. Its main purpose: make payments related to conservatorship, liquidation, or threatened issues of corporate CUs. Payments only happen if the board certifies they'd otherwise come from the main NCUSF. Creates a distinct funding source for corporate CU issues, protecting the main fund for individual member accounts. The Stabilization Fund has its own borrowing authority from the Treasury, combined with NCUSF, up to that $6 billion aggregate limit. Advances are payable with interest. To cover costs and repayments, the board can levy assessments, special premiums on each insured CU based on insured shares, identical for all. If the fund can't make scheduled Treasury repayments, the board must assess a special premium, a key provision. If the Stabilization Fund has outstanding Treasury advances at year-end, the NCUSF can't make its usual distributions to insured CUs. Instead, the max possible amount without harming NCUSF ratios goes to the Stabilization Fund. Ensures the main fund helps repay corporate stabilization before distributing to individual CUs.
Prioritizes paying back the Treasury.
Yes. The board gives annual reports to Congress on the fund's status. It's scheduled to close 90 days after the 7th anniversary of its first advance, or earlier, with remaining funds going to NCUSIF. Ensures it's temporary. An example of how regulation adapts to ensure stability for the whole ecosystem, from smallest local CU to the large corporates serving them.
A crucial response, a temporary buffer, shows that the framework adapts. And if all else fails, or for ongoing liquidity needs, CUs have one more ultimate backstop, the Central Liquidity Facility.
Indeed. The Act establishes the Central Liquidity Facility, CLF, truly the ultimate lender of last resort for credit unions. Its purpose is clear: improve general financial stability by meeting the liquidity needs of credit unions, encouraging savings, supporting lending, providing resources to the economy, a liquidity buffer for the whole system. The Act defines liquidity needs broadly: short-term adjustment credit for temporary needs, seasonal credit for longer periods due to patterns in shares loans, protracted adjustment credit for unusual or emergency circumstances, economic difficulties, covers a wide range. CLF's structure and instrumentality of the U.S. within NCUA, managed by the board. Membership in the CLF comes via subscribing to capital stock. Regular members, CUs serving individuals, subscribe stock equals at least 0.5% of their capital surplus. Agent members, CUs or groups serving other CUs, need board approval. Subscribe stock equals 0.5% of their member CU's capital surplus, those not regular CLF members. Agents perform functions for the board. Members can withdraw with notice, 6 months, 2 years. Board can terminate membership for non-compliance. Capital stock, minimum subscription. At least half transferred to CLF, remainder held by member on call. Extensions of credit are the core function. Members apply for credit for liquidity needs. Board approves T's and I's within 5 working days. Critically, board shall not approve applications if the intent is to expand credit union portfolios.
Strictly for liquidity, not growth.
Explicitly, insurance funds are for shortfalls, preventing disruption, not expansion. Advances based on creditworthiness. If a state CU involved, board consults state insurer. Treasuries can lend up to $500 a CLF if needed. Powers of the CLF are extensive. Board sets rules, assesses costs, acquires property, makes contracts, advances funds to state CU insurers, short-term secured. Importantly, CLF can advance funds to the NCUSF, providing liquidity to the insurance fund itself. CLF agents can also act for check draft collection settlement, interacting with Fed clearinghouses. Fiscal agents for CLF are the Federal Reserve Banks, audit by Comptroller General. Like other CU entities, CLF is generally exempt from most state-local taxation, except real property. Its obligations income also generally exempt, except wealth transfer taxes. It's that crucial safety valve, ensuring CUs have emergency funds, maintaining money flow, especially in stress, the ultimate backstop for cooperative finance stability.
The CLF acts as that crucial safety valve, ensuring access to emergency funds, maintaining system flow during stress, the ultimate backstop. So today, we really navigated the intricate world of credit union regulation. We started with those modern updates in H.R.975, the Credit Union Board Modernization Act, aiming to tailor board meetings to a CU's health and age. Then we went deep into the bedrock, the Federal Credit Union Act itself, understanding its cooperative mission, how CUs form, their broad powers, the critical role of the NCUA watchdog, that robust share insurance fund protecting your deposits, and the ultimate liquidity from the Central Liquidity Facility.
It's quite a system when you lay it all out.
It really is. We've seen how these, sometimes seemingly technical legal provisions all work together. They create a secure, member-focused financial environment. You hopefully now have a comprehensive understanding of the meticulous oversight, the foundational principles that protect your interests as a credit union member.
That's the goal, understanding the framework.
So what does this all mean going forward? Well, the ongoing evolution, like we see with the Credit Union Board Modernization Act, it highlights how regulators continually try to optimize supervision, balancing efficiency for strong institutions with heightened vigilance for those facing challenges.
It's a constant balancing act.
It is. And as financial services keep innovating, adapting to new tech, new economic realities, how might those cooperative principles, the ones embedded in the original Federal Credit Union Act, continue to shape future laws, ensuring that, people of small means stay at the heart of the system, while also fostering a dynamic, resilient financial sector? What aspects of credit union governance do you think will see the next big changes? Something to mull over.